Picture this. You're sitting in your favorite chair, coffee in hand, checking your retirement portfolio. The monthly dividends keep rolling in like clockwork. 8%, 10%, even 12% yields. It feels good, right? But here's the nightmare scenario most retirees don't see coming. Those generous distributions might be slowly cannibalizing your nest egg. You think you're collecting income, but you're actually just getting your own money back with a fancy wrapper. This silent wealth destroyer is called NAV Erosion, and it's plaguing the income ETF landscape like a hidden tax on retirement dreams. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Here's how NAV erosion works. Imagine you have a goose that lays golden eggs. A healthy income fund is like carefully collecting those eggs while keeping the goose well-fed and thriving. NAV erosion is like slowly cooking the goose itself to serve you dinner. Sure, you're eating well today, but eventually there's no goose left. When funds pay out distributions that exceed the actual income and capital gains they generate, they're returning your principal disguised as income. Your account value quietly shrinks month after month, year after year, until you wake up one day and realize your retirement fund is a shadow of what it once was. But today, I'm going to introduce you to 3 champions that have cracked the code. 3 ETFs managing a combined $77 billion that deliver substantial monthly income without destroying your capital. These aren't theoretical unicorns. They have multi-year track records proving they can generate real income through sophisticated option strategies while actually growing their net asset values. We're talking about JEPI, JEPQ, and SPYI. And by the end of this video, you'll know exactly which one fits your retirement strategy. Let's start with the undisputed king of the covered call universe, the JP Morgan Equity Premium Income ETF, ticker JEPI. With over $40 billion in assets under management as of November 2025, JEPI isn't just big, it's enormous. This fund launched on May 20th, 2020, right as the world was grappling with pandemic uncertainty. While markets were volatile and investors were scared, JP Morgan introduced a solution that would become the gold standard for income generation with capital preservation. JEPI's strategy is elegant in its sophistication. The fund operates like a 2-engine aircraft. The first engine invests roughly 80 to 85% of the portfolio in carefully selected large-cap stocks from the S&P 500 universe. But these aren't random picks. The management team focuses on high-quality, lower volatility companies with reasonable valuations. Think blue-chip names like Amazon, Alphabet, Nvidia, Microsoft, and Johnson & Johnson. The portfolio holds 125 stocks, and here's a critical detail. The top 10 holdings represent only 15.77% of assets. That's exceptional diversification, spreading risk across the entire portfolio rather than betting the farm on a handful of giants. The second engine is where the magic happens. Instead of writing covered calls directly on individual stocks, which would create a paperwork nightmare and potential tax complications, JEPI purchases equity-linked notes. These ELNs provide economic exposure to out-of-the-money call option premiums on the S&P 500 index. This structure is brilliant for risk management. Only about 15% of assets go into ELNs, and JP Morgan spreads these trades across 4 to 5 different issuers, typically maintaining exposure to 7 to 9 large global financial institutions. If one counterparty has issues, the fund isn't devastated. Now let's talk performance. JEPI's year-to-date return for 2025 sits at 5.95%. Some might say that's modest, and they'd be right. But here's the thing. JEPI isn't trying to win the race to maximum returns. It's the tortoise in the fable, steady and reliable. The fund delivers an 8.39% dividend yield, which translates to $4.72 per share annually. Every single month since inception, JEPI has paid dividends like clockwork. The latest distribution in November 2025 was $0.34636 per share. For a retiree with $100,000 in JEPI, that's roughly $8,390 in annual income without touching the principal. The 5-year annualized return of 10.38% tells the real story. This includes both price appreciation and those generous distributions. JEPI has grown shareholder wealth while paying substantial income. That's not NAV erosion, that's sustainable wealth generation. The fund's expense ratio of 0.35% is remarkably low for an actively managed strategy, meaning more of those option premiums end up in your pocket rather than paying management fees. JEPI is the protector in our lineup. It's perfect for retirees who prioritize sleep-at-night stability over maximum gains. If you're the type who checks your portfolio daily and panics when markets dip, JEPI is your fund. The diversification across sectors, from information technology at 19% down to materials at just 1.78%, ensures no single industry can torpedo your retirement. The trade-off is clear. You'll lag in raging bull markets like we saw in early 2025, but you'll also suffer smaller losses when markets correct. For someone in their 60s or 70s who can't afford to see their nest egg cut in half, that's a trade worth making. Now let's meet JEPI's younger, bolder sibling, the JP Morgan Nasdaq Equity Premium Income ETF, ticker JEPQ. Launched on May 3, 2022, this fund has experienced explosive growth, reaching $31.46 billion in assets in just 3.5 years. JEP takes the proven JEPI formula and supercharges it with concentrated exposure to Nasdaq 100 technology leaders. JEPQ's portfolio reads like a who's who of the artificial intelligence revolution. NVIDIA dominates at 8.69%, followed by Apple at 7.09%, Microsoft at 6.75%, Alphabet at 5.24%, and Amazon at 4.72%. Notice something? The top 10 holdings represent 47.38% of the fund. That's nearly half the portfolio in 10 stocks. This is aggressive concentration compared to JEPI's diversified approach, but it's also why JEPQ delivers higher income and stronger growth potential. The sector allocation tells the story even more dramatically. Information technology comprises 54.17% of the portfolio. Add communication services at 15.54% and consumer discretionary at 13.73%. And you've got a fund that lives and breathes technology. If you believe artificial intelligence, cloud computing, electric vehicles, and digital transformation are the dominant themes of the next decade, JEPQ is your vehicle. Performance-wise, JEPQ delivers. The year-to-date return for 2025 is 10.13%, roughly double JEPI's return. The dividend yield sits at 10.15 to 10.30%, translating to $5.96 per share annually. The November 2025 distribution was $0.47553 per share. For that same $100,000 investment, JEPQ generates over $10,000 in annual income. Since inception in May 2022 through October 2025, the cumulative return hit 57.9%. That's not just income, that's serious wealth creation. JEPQ proved its mettle during the April 2025 market correction triggered by tariff announcements. While pure tech equity exposure got hammered, JEPQ's option premium income cushioned the blow. The covered call strategy caps some upside, sure, but it also provides meaningful downside protection. The distributions don't disappear when markets drop. They actually can increase because volatility drives higher option premiums. JEPQ is the balanced warrior in our trio. It's ideal for retirees who want growth and income but aren't ready to go full conservative. Maybe you're in your 50s or early 60s, still have income from work, and want your portfolio working harder. Or perhaps you're a tech-savvy retiree who understands the sector and wants exposure while collecting substantial monthly cash flow. JEPQ gives you the best of both worlds. Participation in the most dynamic sector of the economy with a 10% income stream to fund your lifestyle. The same 0.35% expense ratio as JEPI means you're getting institutional quality management at a reasonable cost. Now let's talk about the disruptor, the fund that's rewriting the rules, the NEOS S&P 500 High Income ETF, ticker SPYI. Launched on August 30th, 2022, SPYI has rocketed to $5.85 billion in assets by combining aggressive performance with a secret weapon that most investors don't even know exists: tax efficiency. SPYI invests in S&P 500 stocks, giving you broad market exposure across 506 to 513 holdings. The top holdings mirror the index: NVIDIA at 8.5%, Apple at 6.93%, Microsoft at 6.67%. But SPYI's differentiation isn't in what it owns, but how it generates income. The fund writes covered call options on the S&P 500 index to collect premium income, just like JEPI and JEPQ. But here's the twist: SPYI uses a portion of those premiums to purchase long, out-of-the-money call options. This dynamic strategy allows SPYI to capture more upside in rising markets compared to traditional covered call ETFs that cap all gains at the strike price. Think of it this way: traditional covered call strategies are like putting a ceiling on your gains in exchange for collecting rent. SPYI installs a ceiling but then cuts a skylight that lets you capture additional upside when markets really surge. That's why SPYI's year-to-date 2025 return of 12.77% crushes both JEPI and JEPQ. The one-year return of 15.23% and the three-year annualized return of 17.54% put SPYI in a performance category of its own. But the real game changer is taxes. Because SPYI uses index options rather than equity options, the distributions qualify as Section 1256 contracts under IRS rules. This means capital gains are taxed at favorable 60-40 rates, 60% long-term, 40% short-term, regardless of how long you hold the fund. Even more impressive, approximately 99% of SPYI's distributions as of the most recent data are classified as return of capital. This doesn't mean NAV erosion, it means tax deferral. Return of capital reduces your cost basis and isn't taxed until you sell the fund. For investors in high tax brackets holding SPYI in taxable accounts, this is a massive advantage. Let me put this in perspective. If you're in the 32% tax bracket and collect $10,000 from JEPI or JEPQ, you might pay $3,200 in taxes, leaving you $7,800. That same $10,000 from SPYI? Potentially zero current tax, with taxation deferred until you sell. Over decades, the compounding effect of not paying annual taxes on distributions can add hundreds of thousands to your net worth. SPYI's distribution rate leads the pack at 12.15 to 12.16%. The October 2025 distribution was $0.527 per share, and distributions have remained remarkably stable throughout the year. For our $100,000 example, SPYI generates roughly $12,150 annually. Combined with the 12.77% year-to-date price appreciation, you're looking at total returns that rival pure equity exposure while collecting income that rivals high-yield bonds. The expense ratio of 0.68% is nearly double JEPI and GPQ, but consider what you're getting: tax-efficient structuring, superior performance, and a dynamic strategy that captures more market upside. The higher fee is justified by the value delivered. Interestingly, despite having the highest returns, SPYI has the lowest beta at 0.82, meaning it's actually less volatile than its peers. SPYI is the total return champion. It's perfect for retirees who want maximum performance, hold investments in taxable accounts, and can accept slightly higher concentration in mega-cap stocks. If you're comparing SPYI to JEPI and thinking the extra returns are worth the trade-offs, you're probably right. Since inception in August 2022, SPYI has delivered 56% cumulative returns. That's doubling your money in about 3 years while collecting double-digit income. So which fund should you choose? Here's your decision framework. Choose JEPI if you prioritize maximum stability and downside protection. If you want broad diversification across sectors, need a proven 5-year track record, and prefer lower concentration in mega-cap tech, JEPI is your fund. It's the safe harbor, the protector, the sleep-at-night choice. Choose GEPQ if you want higher income above 10% with growth exposure. If you believe in long-term outperformance of technology, can tolerate higher concentration in tech megacaps, and seek balance between income and capital appreciation, JEPQ is ideal. It's the sweet spot for retirees who want to participate in the AI revolution while funding retirement spending. Choose SPYI if you prioritize total return alongside high income. If you hold investments in taxable accounts where tax efficiency is critical, want maximum upside capture in bull markets, and can accept a slightly higher expense ratio for better after-tax performance, SPYI is your champion. It's the performance leader, delivering 12% plus income with the highest total returns and the best tax treatment. But here's a thought. Why choose just one? A diversified allocation across all three ETFs might provide optimal results. Imagine allocating 40% to JEPI for stability, 30% to GPQ for growth-oriented income, and 30% to SPYI for total return and tax efficiency. This combination balances conservative downside protection with meaningful upside participation while generating substantial monthly cash flow averaging over 10% across the portfolio. You get the safety of JEPI, the growth of JEPQ, and the tax efficiency of SPYI, all working together to fund your retirement. The critical insight is this. These three ETFs have proven they can deliver high income without NAV erosion. That's rare, almost unique in the income-focused ETF landscape. Unlike many high-yield products that gradually destroy capital by returning investor money disguised as distributions, JEPI, JEPQ, and SPYI generate genuine income through options premiums while maintaining or growing their underlying asset values. This sustainable approach makes them genuinely suitable for retirement portfolios where capital preservation is paramount. As of November 7, 2025, all three funds continue demonstrating strong flows, stable NAV performance, and consistent monthly distributions. Record inflows of $31.5 billion poured into derivative income funds in the first half of 2025 alone, and these three ETFs captured the lion's share. That's not hype. That's a vote of confidence from financial advisors and sophisticated investors who've done their homework. Remember, while these funds have shown no NAV erosion historically, past performance doesn't guarantee future results. Markets change, strategies evolve, and what works today might face challenges tomorrow. Always consult with a qualified financial advisor before making investment decisions, especially with retirement assets. But armed with the knowledge you now have about JEPI, JEPQ, and SPYI, you're equipped to have intelligent conversations about sustainable income generation. If this video helped clarify the covered call ETF landscape, smash that like button and subscribe for more retirement investing insights. Drop a comment below. Which of these three funds resonates most with your retirement strategy? Are you Team JEPI for safety, Team GPQ for balanced growth, or Team SPYI for maximum returns? I read every comment, and your perspectives help shape future content. Until next time, invest wisely and enjoy that monthly income without the NAV erosion nightmare.